Dividend stocks versus growth stocks. What is the difference? Is one investing strategy better than the other? Or is there another option which gets the best of both worlds? So the main difference between the two investing strategies ultimately comes down to the decisions made by the company's management team and what they choose to do with the company's profit. If the management team don't think they can reinvest a profit and earn a higher return, then a certain percentage of the profit is paid out to shareholders, which is called the payout ratio. However, if the company's management team does believe they can get a better return with the profits earned, they will retain all the net income to reinvest back into the business to grow their revenue and ultimately net income. This should reflect in a higher stock price if the market is acting rationally, as there's more profit for each shareholder or earnings per share. Companies that do not pay a dividend and largely reinvest back into their business are deemed growth stocks, where the main focus is increasing the share price for capital appreciation. New companies that have just started their journey are typically focused on growing their revenue in expansion mode to address their total addressable market as fast as possible, so retaining all their profits to fund this growth is critical, and paying out dividends will slow them down. On the flip side, larger, stable, well-established companies that have already filled most of their total addressable market and have limited revenue growth focus on paying out their consistent cash flow to shareholders. When it comes to comparing the two investing strategies, we first look at what they both offer. Dividend stocks offer stable, consistent cash flow to shareholders, while growth stocks tend to offer higher capital/share price increases over longer time horizons, where investors currently don't need the money. Next is the risk and volatility of the type of stocks. Typically, with stable dividend-paying companies, they are less volatile when it comes to the share price moving around, and is for people with a lower risk tolerance, with the likelihood of getting dividend returns consistently. Growth stocks are more volatile and can be viewed as more risky, as revenue forecasts can be incorrect and vary to the market's expectations, resulting in fast movements up or down in the share price. Typically, these are for younger people or investors looking for capital appreciation with a longer time horizon to wait out the volatility. Dividend stocks tend to gravitate towards value investors, whether it be companies currently priced under their intrinsic value or seeking the consistent dividend cash flow now. Growth stocks is all about capital growth, wanting all profits to be retained and increase the share price as fast as possible. The upside of both types of stocks varies slightly, with dividend stocks providing constant cash flow with dividends and also increasing the share price, investing with the remaining retained earnings to further increase profit or share buybacks. Growth stocks typically don't pay dividends at all, or a very tiny one that is almost negligible, and the focus is on the share price going up with higher profits, and also through share buybacks, increasing the earnings per share. Types of companies that pay dividends are mature and well-established, who can reliably and consistently predict their cash flows with no major deviations from market expectations. Growth stocks, on the other hand, are much smaller and retain all their earnings to continue growing revenue and profit as they fill their total addressable market. During bear markets, dividend stocks tend to perform much better as investors continue to hold their shares and buy more due to the consistent paycheck dividends provide, even if the share price doesn't go up. Growth stocks tend to underperform as investors want to raise cash quickly to lock in their profits, as there is no dividend to keep investors holding. Value investors tend to lean towards dividend stocks that present great dividend income whilst they are currently trading under what they calculate to be the intrinsic value of the company, compared to growth stocks, where the current intrinsic value is harder to calculate based on the expected higher growth rate of their revenue and net profit. As long as the growth rate is sustained, investors will keep paying at or above the intrinsic value for growth stocks. When it comes to dividend stocks, the dividend yield and payout ratio are the most common ratios that investors will monitor. However, these cannot be the sole ratios to look at, as they can be deceiving depending on whether the company is using debt to pay the dividend, and the dividend yield is largely dependent on the current share price. The main metric for growth stocks is the current and forward PE ratios, which compare growth rates of the companies against expected revenue and net income growth. Now, when it came to me first starting to invest, deciding which strategy to go with was one of the first questions I had, and it ultimately led to a lot of analysis paralysis, which is basically the inability to make a decision due to overthinking a situation. When you first start looking at investing, there is an avalanche of information thrown at you immediately, and it can scare people off for being too complicated or delay them starting their investing journey, which is perfectly okay in a lot of situations because you are putting your hard-earned money at risk to hopefully make a return. The end result of this paralysis can put you in a constant loop of questioning yourself over whether you want to invest in individual stocks, bonds, index funds, or ETFs, and the longer this goes on, the more dividends you miss out on along the way. And as the saying goes, time in the market beats timing the market for this very reason. This is mainly driven by anxiety from the fear of making the wrong decision. Now, ultimately, when it comes to either dividend or growth stock investing, there isn't really many wrong decisions you can make, as behaviourally, you are starting to think about your future self and invest, so that you're not solely reliant on your job income. Both strategies will perform well. If you prefer knowing you're going to consistently earn income passively from dividends, then that strategy may be for you. If it's growth investing, where you want to quickly grow the portfolio value and minimize your tax with capital gains tax discounts along the way, then that's great too. Now, if you like the sounds of both of these strategies, then luckily enough there's a third option, which is even easier to implement, where you don't have to do any work whatsoever keeping up with each stock, and that is index or ETF investing. Initially, when I first started investing, I heavily leaned towards the growth strategy, as I wanted to minimize the amount of tax I would pay by taking advantage of the 50% capital gains discount, and I also have a long time horizon to retirement to weather any volatility. This is why I initially bought the growth ETFs FANG, NDQ, and Asia in the portfolio. FANG and NDQ are largely focused on US tech companies that are predominantly growth stocks such as Apple, Microsoft, Amazon, and Tesla. There is also the Asia ETF, which is focused purely on Asian tech stocks such as Samsung, Alibaba, and Tencent. These ETFs are mainly for capital growth instead of dividend income. My thoughts and investing strategy have changed over the years, and I've been simplifying the portfolio by focusing on index ETFs, one for my domestic country Australia, which is the Vanguard ETF VAS, and one for developed international markets, which is another Vanguard ETF VGS. These two ETFs form the core of my portfolio outside of my superannuation retirement account, and it's actually 100% of the portfolio inside super. My ultimate goal is to eventually live off the dividend income from these two ETFs, plus sell down small portions if needed. And in the meantime, it is so much easier just constantly putting money into these two ETFs without having to think about whether it's a good time to buy, and I still get the benefit of both dividends and capital growth. For example, VGS still has all the growth stocks already in FANG and NDQ, with Apple, Microsoft, Amazon, and Tesla making up a top percentage of the portfolio, along with great dividend-paying companies such as JP Morgan, Johnson & Johnson, and Home Depot in the top 10 holdings, which increases the overall portfolio dividend yield. When it comes to dividends, Australian shares tend to pay more, shown by the higher dividend yields, and we also get franking credits to help offset the tax payable by the individual. The larger companies in the Australian index are predominantly banks and mining companies that have consistent dividend payments, and with the tax laws in the country, tends to make management teams lean towards paying shareholders dividends. I'm at the point now where I don't care about all the choices and constant news barrage of what strategy of the week is outperforming another. This is all just white noise to me now, and I just constantly dollar cost average into my two main ETFs, VAS and VGS, and buy heavier when the market dips down. Dollar cost averaging into index funds or index tracking ETFs is the best option over the long term, beating most actively managed funds, and comes with lower fees, saving us more money to be invested. So is growth or dividend stocks the better option? It depends on what you want, but I like having the best of both worlds with index ETFs. So that's what I choose, and it's much easier to consistently implement. If you'd like to try Perler out, which is the investing platform I'm using here on the screen to track all your investments, your home loans, the equity in your house, and your superannuation, I'll leave a link below in the descriptions and the comments so you can sign up and get 2 free trades. And that's all from today, guys. I'll see you in the next one.